Okay, today we'll be looking at flexed budgets, and we'll also consider standard costing that looks at how we flex budget, how we show the costing and the sales and overhead budgets. So a flexed budget is actually a budget that considers the quantity of production against the actual that is budgeted against the actual production in units. For instance, if 10,000 units were budgeted to be produced and 12,000 units were actually produced, the expenses, or rather the costs and the revenue that were expected for 10,000 units would be flexed, would be stretched to reflect 12,000. And that is what we now compare with the actual activities, with the actual cost and revenues. An example here, the manager of Getang Limited provides the following information for the production of servings during March. So 8,000 servings were budgeted. An actual output of servings was 70,000. That means it is very important to now flex this 80,000 to show 70,000, so that we now compare the costing of 70,000 actual with flexed 70,000 of servings. So also budgeted use of direct materials was 2,400 liters and actual use was 220,000. Now, with if 80,000 is budgeted and 240,000 is budgeted to be used, so how many liters of direct materials will be used for 70,000? That is flexing. So it is just if 80,000 is used for 240 liters, 240 liters is used for 80,000 servings. That means for 70,000 servings, you can cross multiply. It will be 70,000 times 240 liters, 1,000 liters divided by 80,000. That will give us an answer of the flexed budget, which is done here. So flexed budget will be 70,000. So and it will be 7 over 8 times 240,000, which is 210,000. Basically, how many liters would we have budgeted for if it was if it was 80,000, sorry, if it was 70,000 servings that was produced, because actual servings was 70,000. It means that it will not reflect fair assessment or fair comparison if you are comparing 80,000 servings with was budgeted before with 70,000 actual. It should be like for like, which means we should flex budget for 70,000 for actual 70,000 servings, which we did by doing 7 over 8. That's times 240,000. Basically, put 70,000 here. So how many liters would you budget to use? So it will be 70,000 times 240,000 divided by 80,000. That will give you 210 liters budgeted, but actual was 220. That means there is variance of 10,000 liters. So 10,000 liters were used that had not been budgeted for. So this is an adverse result. That means we used more than budgeted for. The reasons for this wastage should be investigated and, if possible, a remedy sought. It will also be necessary to flex the standards set for the use of direct labor. So, for instance, if we were also given labor used, so we will also just flex it to reflect 70,000. Whatever the amount of labor budgeted before for 80,000, we'll just bring that amount, multiply it by 70,000, divide it by 80,000. That will give us the answer of the flexed labor, and we'll compare it with whatever the value of actual labor that was incurred. Now, fixed overhead capacity variance. This is when you calculate the difference in hours worked and budgeted hours. It is adverse when actual hours are less than budgeted and vice versa. Fixed overhead volume efficiency variance. The variance is the difference between the standard hours and actual hours multiplied by OAR. OAR is your overhead absorption rates. This is well covered in absorption costing. We'll review that topic and upload the video in this channel, Accounts and Business Made Easy, very soon. But we are considering OAR in relation to labor hours as the activity level. So the variance is the difference between the standard hours and the actual hours. The difference, will multiply it by OAR, overhead absorption rate. So let's look at this example. The following information regarding fixed overheads is available for Marketio for the month of February. Budgeted fixed overhead is 10 hours at 4.5. The budgeted production level was 1,000 units. Budgeted fixed overhead was 45,000. Actual fixed overhead is $38 to $50. 900 units were produced. Take note, 900 units were produced, but 1,000 was budgeted for. That is telling us we should flex the budget to reflect 900 units so that we can compare like for like. Marketio absorbs fixed overheads on the basis of direct labor hours. So our OAR will be considering direct labor hours as the activity level. So we are to prepare expenditure variance, capacity variance, efficiency variance, volume variance, and total overhead variance. So expenditure variance is actual expenditure minus budgeted expenditure. Our actual expenditure is 38 to 50 and budgeted expenditure is 45. Let's go back to the question. Actual expenditure is 38 to 50 and 45 times 1,000. 45 times 1,000, that's 45,000. Then actual is 38 to 50. That means we budgeted 45 and we spent less. That is a favorable variance. That is favorable variance. Then fixed overhead expenditure, overhead absorption rate was 6,750 greater than needed. So it's a favorable variance. B, capacity variance. Budgeted overhead, the formula is budgeted overhead minus actual hours worked multiplied by overhead absorption rate, which is budgeted overhead is 45,000 minus overhead absorption rate, which is actual hours work times overhead absorption rate is 38 to 50, which is 6,750 adverse. Actual hours are less than the budgeted hours, so not enough overhead has been absorbed into production. Efficiency variance equals total hours worked minus standard hours worked for actual production multiplied by fixed overhead rate per direct labor hour. So to get that, let's go back to the question. 85 hours was the actual hours for this unit, and we compare these hours worked of 8,500 with the 9,000 hours. That means we have 500 hours as variance here, multiplied by 4.5 as the cost per unit here. Cost per unit here. Can see? So 4.5 multiplied by the 500 difference will give us 2,250 favorable The work is worth 9,000 standard hours, but it only took 8,500 hours to complete production. So it is favorable. It is favorable. We spent less than required hours. So the other hours that is spared can be used for other things, can be a buffer for other things to be done. So volume variance is equal to budgeted variance, budgeted overhead, which is 45,000 minus actual hours worked multiplied by the absorption rate. So 45,000 minus 4050, which we got as 9,000 multiplied by 4.5. So that means there is the difference between this and this is 4,500 adverse volume variance. That means there is an adverse usage of the volume. Actual fixed overhead is equal to 38,250 as we were given in the question. 38,250 here. Total standard cost for actual production equals 40,250. Hence, the variance of this and this, the difference is 2,250, and it is a favorable difference. That means we spent less than budgeted. We spent 38,250 than budgeted of 40,500. Next is sales variance. So this just considers our sales budgeted with the sales actual, and we look at favorable or adverse variance as the case may be. So example here, budgeted sales of red row were 11,000 units at 6.3 per unit. It was 11,000 units at 6.3 per unit, $6.3. The actual sales were The actual sales were 10,800 at 6.4 per unit. So units of sales budgeted was more than units of sales made eventually. And the price or selling price was also different from the actual. So calculate the sales volume variance. We'll do this with this formula. SQ is standard quantity of sales. SP is standard price. So standard quantity is 11,000. Standard price is 6.3. AQ times SP. AQ is actual quantity. Actual quantity is 10,800 and actual price is 6.4. So to get sales volume variance subvariance, that's units of sales made comparing actual with the budgeted. So that is SP times SQ is 68,200. Then AQ times SP is 66,960. The difference between the two is our sales volume variance or subvariance. And if you look at it very well, whether to check whether it's favorable or adverse, we budgeted to sell 11,000 and we sold 10,800. So that is bad. That is less than good thing. We budgeted to sell up to 11,000, but we couldn't sell up to 11,000. We sold 10,800. So that means the answer multiplied by 6.3. It should be 6.3. It should be 6.3 was the standard price is 6.3. So this amount here should be 6.3. 11,000 times 6.3, 10,800 times 6.3. So the difference is adverse, and that is volume subvariance, sales volume subvariance. Also, the sales price subvariance, that's AQ times SP minus AQ times AP. AQ is actual quantity sold, that's 10,800. Then standard price is 6.3. Sorry, this is 6.3 as is given in the question. Then actual quantity is 10,800 as given here. Then actual price is 6.4. So this multiplied by this, we find the answer. This multiplied by this, we find the answer. The difference between the two is the sales price subvariance. So the addition of sales volumes of variance and sales price of variance will give us total sales variance. So 1240, take note please, 6.2 and 6.2 were used here instead of 6.3. So we will go with that answer for now. Apologies for you on that. Please take note of that. 1240 adverse and 2160 favorable. That's minus 1240 plus 2160. The answer is plus 920. That is our answer for C, the total sales variance. So on this note, we'll call this class a day. However, if you have any question, kindly make any question or contribution or comment, please write it in the comment section, and be sure that there will be response if it is a question for you. Thanks for watching. And my credit to Jasmine, who was helpful in making this resource available, and credit to uh, the one of the materials used, which is a Cambridge A-level accounting, and credit to Viber and Subin, who are both useful in making this software available for me to use. Thank you all, and thank you very importantly to my audience for watching the YouTube channel and this particular video. We see you again. We hope to keep ourselves safe, and please enjoy the rest of the time. Finally, Yukta was also resourceful.